This is a video on calculating earnings per share. Now, if we wanted to find earnings per share, it is called the amount of current period earnings that can be associated with one share of common stock, and we call it earnings per share. There are several different categories of earnings per share. The category that we're going to deal with right now is what is called basic earnings per share, or BEPS. And the way we calculate the basic earnings per share is we take the income that's available to the common shareholders and we divide it by the weighted average number of common shares outstanding. So let's take a look at the numerator first and how we calculate the income that's available to common shareholders. We start out with net income for the income statement. From that then, we're going to subtract any type of dividends that are paid on preferred stock. Remember that preferred stock has a characteristic that typically if the board of directors declares dividends, the preferred shareholders have to be paid first. And remember, when we pay a preferred shareholder their dividend, that amount is not subtracted from our net income. It comes after net income. So in order to get the amount that is actually available to the common shareholders, we have to subtract any dividends that affect the preferred stock. Now there's two types of dividends that we have to be concerned about. We need to subtract out any current dividends on what we call non-cumulative preferred stock. Now non-cumulative means that if the board of directors does not declare dividends during a particular year, that preferred stock also will not receive any dividends, nor is there a liability or an obligation on the company's part to have to ever pay those dividends once they're passed up. So the only time we're going to deduct non-cumulative preferred stock dividends is if those dividends are actually or have actually been declared. Now there's another type of preferred stock, and it's called cumulative preferred stock. In this particular case, cumulative preferred stock means that even if the board of directors doesn't declare a dividend in that current year, the amount of dividends attributable to the cumulative preferred stock will in effect accrue as a liability against the company. In other words, before any common stockholders are paid anything, the cumulative preferred shareholders have to be paid first. So in the case of cumulative preferred stock, even if dividends are not declared, we still subtract those dividends out. So even if they're not declared, we'd still subtract those dividends out. And those two elements subtracted from net income equals the income available to common shareholders. The next area then is the denominator, and basically we use the weighted average number of common shares outstanding. And the calculation actually is fairly simple because it does deal with the weighted average between stock transactions between the company and the open market. Let's take a look on January the 1st. The beginning balance, the number of common shares outstanding is 240,000 shares. Now on March 1st, the company then issues 100,000 shares. So what happens is that we know the 240,000 shares from our beginning balance basically existed in January and February. Then it's going to change in March. But now we have to account for those weighted average shares for January and February, which are 2 months. So we take 240,000 common shares times 2/12. Our weighted average then for those 2 months comes up to 40,000 shares. We have a transaction on March 1st. We reissued 100,000 shares. And you can see the common shares outstanding went from 240,000. We increased them by 100,000. So now we have 340,000 shares outstanding. And that amount remained consistent until August 1st. So if we take a look, then it would be March, April, May, and June. That would be 5 months. So we would take the 340,000 times 5/12, and that becomes 141,667 weighted shares. August 1st, and we have another stock transaction where the company repurchased 50,000 shares from the open market. In this case, we take our beginning balance of 340,000, we subtract out our 50,000 shares, and we end up with 290,000 shares remaining. And again, this 290,000 shares, so that would be 3/12, which would be 290,000 times 3/12 equals 72,500 weighted average. On November the 1st, then, we issued another 70,000 shares, so we would have 290,000 shares plus the 70,000 shares equals 360,000 times November and December, 2 months, so that would be times 2/12, and that's going to equal $60,000. So we take up our weighted, we total up our weighted average per share, and the weighted average in this case would come out to 314,167,000 shares. Now let's go on, and we're going to make the process just a little bit more, sorry, I went too far. We're going to make the process just a little bit more complicated. Now, again, we talked about, we calculate earnings per share based upon the weighted average number of common shares outstanding. However, there are cases where a company will create a stock dividend or a stock split. Under those conditions, weighted shares must be adjusted retroactively, just as if the transaction had occurred at the very beginning of the accounting year or the accounting period. Now, also, if we present earnings per share for prior year financial statements, the earnings per share regarding those prior years also basically must be retroactively adjusted. So stock dividends and stock splits extend to prior periods in which EPS is also presented. Now you can see here again, this is pretty much the transactions produced from the previous slide where I had January 1st, March 1st, August 1st, and November 1st. We do have a transaction on June the 1st where the company issued a 20% stock dividend. Now, in the case of the box here where we say no split, you can see this is exactly the same information from the previous slide. And we didn't do anything for the June 1st transaction because in this case there was no split assumed, so that's not applicable. But let's see what happens now when we create the stock, when we actually now create the stock split. Okay, again, we have 240,000 common shares outstanding. But on June the 1st, we issued a 20% stock dividend on 340,000 shares. So now what we need to do is we need to go back to prior periods and retroactively adjust our common shares outstanding for our 20% stock dividend. So we take the 240,000 common shares, we multiply them times 1.2, which accounts for our 20% stock split. We then multiply that amount by 2/12 for the 2 months out of the year that this amount existed, and we come out with a weighted average of 48,000 shares. Okay, now we go back and again take a look at our old common shares outstanding, where again it was 240 plus 100 equals 340. We need to retroactively adjust those 340,000 shares by 1.2, multiply it times 1.2, then multiply that times the 5 months those shares were outstanding. And we end up with 170,000 shares. Now, on June the 1st, then, we make our adjustment with the split from, we take our 340,000 shares and we have our 20% stock dividend. So we add 68,000 shares, which is 340,000 times 20%. So now we have 408,000 shares outstanding. Now at this point, we don't have to retroactively adjust anything anymore because now we restated our stock with the stock split. So we take our beginning balance on August 1st, we repurchase shares, in this case 50,000 shares, so we take 408,000 minus 50,000 shares, and now we end up with 358,000 shares times the 3/12 equals 89,500. We take the 358,000 and we carry it to November 1st, where we issue 70,000 shares. So we take the 358,000 plus 70,000, and we end up with 428,000 shares for the last 2 months out of the year. So we multiply that times 2/12, and we end up with a weighted average of 71,333 shares. So at the end then, with the stock split, our weighted average shares would now be 378,833 shares. Okay, here's a question on weighted average shares. Ping Bong Corp had the following common stock transactions at the beginning of each month during the year. January, we had common stock outstanding of 30,000 shares. In February, there was a common stock dividend. Then in July, we sold 8,000 shares of common stock. And the question is, what are Ping's weighted average shares outstanding for the year? So again, go ahead and perform your computation. Before you do that, though, of course, stop the video, perform your computation. Then when you're ready to check your answer, go ahead and restart the video. Okay, number one. Again, Ping Bong had the following common stock transactions, and we're given the transactions, and it says, what are Ping's weighted average shares outstanding for the year? In this case, the answer is D, 37,000 shares. And we can take a look at our calculation here. And January, we had a beginning balance of 30,000 shares outstanding. However, in February, we have to, and that was outstanding for 1 month because we had a common stock dividend in February. So we have to have a retroactive adjustment to January. So we had 30,000 shares times 1.1, because it's a 10% dividend, times 1/12, and we end up with 2,750 weighted shares. On February the 1st, then, we have to issue a stock dividend. This is on 30,000 shares. So now we add 3,000 shares to the 30,000 shares, and we end up with 33,000 shares of stock. Those 33,000 shares of stock then are going to be carried for 5/12 of the year. So our weighted average is 13,750 shares. Lastly, on July 1st, we issued another 8,000 shares. So the 8,000 shares added on to the 33,000 shares ends up at 41,000 shares, and that's for the last 6 months of the year. So our weighted average in this case is 20,500. So what we have now would be a weighted average of 37,000 shares. Okay, now let's go on and take a look at another category of earnings per share. And we call these diluted earnings per share as opposed to basic earnings per share. And the generally accepted accounting principles state that if a corporation has a complex capital structure, and when we say complex capital structure, that pretty much means that if it has something more than simply common stock. So if the corporation has a complex capital structure, the corporation must report diluted earnings per share as if, in effect, the securities had been converted. In other words, those convertible securities had been converted into common shares where they're convertible. And that includes things like convertible debt or equity, warrants or stock options, contracts that may be settled in stock, or contingent shares. Now, again, the calculation itself, you have a numerator and denominator, and you have the income that is available to the common shareholders, and the denominator is a weighted average number of common shares, basically dilutive shares outstanding. Now the calculation on the income available to common shareholders is a little more complex. And we start out again with our net income, and then we're going to subtract out any current dividends on non-cumulative preferred stock or current dividends on cumulative preferred stock, even if they're not declared. And that's the first step of our income available to common shareholders. However, what we're going to do is we're going to basically assume under diluted earnings per share that the securities that could be converted to common stock are converted. So what we need to do is we need now to assume that all the convertible stock, all the convertible securities are being converted to the common shares. So if that happens, we have to add back any preferred dividends that would have been avoided if the preferred securities had been converted into common stock, because we're not going to pay preferred dividends on stock, on preferred stock, if that stock has been converted into common stock. Also, we're going to add back any interest on convertible debt that would have been avoided had the convertible debt been converted into common stock. In other words, if we have bonds out there that are convertible and we're paying interest on them, if people convert those bonds, what we can do then is we're not going to have to pay the interest because those bonds are being converted to stock. So we need to add that back to the income available to shareholders. So then the next item we get to is this amounts to the income available to common shareholders if convertible securities were converted into common stock. So it has to go through this, the income has to go through this series of adjustments. Now we have to take a look at what we call diluted shares. And again, these are securities that could be converted to common stock. Okay, we assume that they are converted to common stock and they're included in calculating the weighted average shares of common stock outstanding. Now, dilution is calculated using one of two methods. For convertible securities, we use what we call the if converted method, where it is assumed that the securities were converted to common shares at the beginning of the reporting period. Also, for options and warrants and their equivalents, in that case we use what we call the treasury stock method. That assumes a portion of the stock issue will be purchased on the open market with the proceeds that the option grantee paid for the option. The difference between the common stock to be issued for the option versus a stock price purchased on the open market will result in additional shares for dilution. I know that doesn't make a ton of sense right now, but you will see it in action and it'll make a lot more sense. Now, in a lot of cases, we have to make separate calculations based upon the security in terms, convertible securities. There may be several different types, and they may be converted at different rates, and the same thing for warrants and their equivalents. One of the things when we're calculating diluted earnings per share is securities that are anti-dilutive are not included in the diluted earnings per share calculation. So what that means is if one of these shares that you have done the calculation on actually increases the earnings per share, that amount cannot be included in the diluted earnings per share calculation. And again, diluted earnings per share, we have to assume that the diluted earnings per share, if we present this in the financial statements from prior periods, we have to assume again that these diluted earnings per share, these calculations occurred in the prior periods. Okay, now let's take a look at an example. Here we have an example for the conversion of convertible securities. In other words, if it's a convertible security, we're going to use the if converted method. Now, this problem has a lot of wording in it, so we're going to have to go through the whole problem. Tower 1 had $500,000 of net income. So we know our net income. We also know that Tower 1 has 100,000 common shares outstanding, and it's for the entire year. So we don't have to deal with weighted average calculations. The company's effective tax rate is 20%, so they pay 20% on average for their against their income. Now the company has $500,000 worth of 10-year 5% convertible bonds, and they have a face value of $1,000 apiece. So when we think about that, that means we must have 500 actual bonds out there. 500 bonds times 1,000 is going to equal the 500,000. Now in this particular case, each of those bonds that is out there is convertible into 10 shares of Tower's common stock. So if the bondholder wants to convert their bond into Tower's common stock, they have to submit that bond basically to the corporation, and that debt then is extinguished, and then the corporation issues the former bondholder 10 shares of Tower's common stock. The company had 10,000 shares of $20 par, what we call 10% cumulative convertible stock. Now, what we mean is that when we say 10%, that's the amount of the dividend that would be paid based upon 10% of the par value on a yearly basis. We also know it's cumulative, so that means even if we don't declare a dividend, the company still owes the 10% times the $20 par value for the stock. Each share of that preferred stock can be converted into 5 shares of common stock. Prior to the beginning of the year, there were no dividends in arrears pertaining to the preferred stock. No common or preferred dividends have been declared by the end of the current year. So we know there's no common dividends that are declared. We do know, though, that basically that our preferred shareholders are cumulative, so the company will have a liability in terms of paying the dividends on those preferred shares of common stock. Now, if I'm going to do a calculation on my primary earnings per share or basic earnings per share, the calculation is actually fairly simple. In this case, it's going to be equal to my $500,000 net income minus my $20,000 worth of cumulative dividends. Now, where did I get that $20,000 from? It's going to be my cumulative dividends. The par value of my total stock would be $200,000. $20 par times 10,000 shares would be $200,000. So we're going to pay 10% dividends on a total par value of $200,000. So that comes out to $20,000 of cumulative dividends. So it's $500,000 net income minus my $20,000 of cumulative dividends divided by my 100,000 common shares. So it comes out to $4.80 a share. I had to make no adjustments to my common shares because under my basic earnings per share, I make no adjustments regarding convertible securities or stock or any type of convertible securities assumptions. Now, I need to do my diluted or fully diluted earnings per share. The first thing I need to do is I need to make an adjustment to my net income, assuming conversion of my securities. Now, in the case of my convertible bonds equal my $500,000 worth of total convertible bonds. Remember, the interest rate on those bonds is 5%. So I'd be paying interest of $25,000 a year. But if I look at it net of taxes, my tax effect is $25,000 times 1 minus my 20% tax rate. The amount of interest that I'm going to be adding back to net income would be $20,000. So I'm going to add that amount back to net income because I wouldn't have to be paying that interest. Okay, convertible stock. Okay, in the case of convertible stock, we did accrue in effect this liability, dividends in arrears on the $20,000 worth of cumulative dividends on the cumulative stock. So again, we need to add that amount back. That will be income now available to the common shareholders because it's as if the convertible stockholders converted all their stock at the beginning of the year back into common stock. So again, they have a $200,000 par value, which is our 10,000 shares times $20 par, times our 10% dividend rate equals the $20,000. So that's our adjustments to net income available to shareholders. Now we need to make an adjustment to our common shares outstanding, assuming that there's a conversion of our securities. So let's start off with our convertible bonds first. Again, there were 500 bonds, and we know that because the company had $500,000 worth of $1,000 par bonds. So that would be $500 a bond, or 500 bonds rather. And I show that here, 500 bonds, that's computed by $500,000 worth of bonds divided by its $1,000 par value per bond, times 10 shares. That represents the amount, the 10 shares that you can convert the bonds into, so times 10 shares. That means that the company would have, in order to convert all the bonds, would have had to issue an additional 5,000 shares of common stock. Now let's take a look at the convertible stock. We know in the convertible stock that each share of preferred stock can be converted into 5 shares of common stock. So we take the 10,000 shares of the cumulative convertible preferred stock times 5 shares, and that's going to equal 50,000 shares. Now what we want to do is do our calculation on diluted earnings per share. We start out with the total income available to common shareholders of $540,000. Now remember, that's going to consist of our $500,000 net income plus the $20,000 of interest we can avoid since those bondholders converted from the bond to the common stock. Plus, we're able to also avoid the $20,000 worth of dividends payable to preferred shareholders because those preferred shareholders would have also converted to common stock. So that totals up to $540,000. We're going to divide that by 155,000 shares. The way we get that is we start off with the original 100,000 shares. We add to that 5,000 shares that would have been added from our convertible bonds, and plus 50,000 shares that would have been added from our convertible stock. When we do that, we come up with a fully diluted earnings per share of $3.48 per share. Now let's take a look at an example of conversion of options. And again, when we're converting options and warrants, that's utilizing the treasury stock method. Tower 1 had $500,000 of net income and 100,000 common shares outstanding for the entire year. The company's effective tax rate is 20%. Key employees were given options to purchase a total of 20,000 shares in total, we're talking about in total, of common stock, and they can purchase the stock at a price of $15 a share. The average market price was $20 a share during the year, and the end of the accounting period price, the price was $25 a share. Now, again, if we had decided that when we want to calculate our earnings per share, our basic earnings per share, in this case, it would be a matter of we have no convertible securities out there where we're paying anything in bonds or dividends. So in this case, our net income available to common shareholders is going to be $500,000. We're going to divide that by the 100,000 common shares, and that comes up to you $5 earnings per share. Okay, now what we're going to do is we're going to see if we need to adjust any type of net income that would be available to common shareholders. And since these are simply options or warrants, there's no adjustment that is necessary. So now we need to do an adjustment to the common shares outstanding, assuming there's a conversion of securities. And that's what we do, is we have to basically assume that all these options were converted at the beginning of the year using what we call the treasury stock method. So assuming that all the options were converted, the 20,000 options, we have to calculate, if that happened, what are the cash receipts from the options that in effect people paid for? Well, we take that $15 option exercise price that the employee had to pay and multiply that times our 20,000 shares. In other words, the shares that they're buying. That means there's going to be $300,000 of cash proceeds that we're going to receive upon the exercise. Okay, so what happens is we take that $300,000 worth of cash receipts, and now we estimate if we, during the year, if we went out on the open market and purchased those shares in order to pay, in effect, fulfill that obligation of conveying those 20,000 shares to the employees, how many shares could we purchase? So we take the $300,000 worth of cash receipts, we divide it by the average price during the year of $20 a share, and what that tells us is on average in the open market, we could have purchased 15,000 shares of our own stock to give to the employees purchasing the options. However, there's a bit of a problem here because we only were able to purchase 15,000 shares. And the options, basically, if the options are fully exercised, there would be 20,000 options. So we're going to have to actually basically create, or issue rather, additional shares of common stock that will be needed to be issued above those repurchased shares to make up for the difference. So the shares that we owe regarding the options is 20,000 shares. We subtract out the 15 shares, it can be purchased on the open market with the proceeds, and the remainder of 5,000 shares are new shares that we're going to have to issue to make up the difference to the 20,000 shares. So in this case, when we take a look at our diluted earnings per share, it would be our $500,000 net income divided by 105,000 shares, which is equal to 100,000 shares plus the 5,000 shares additional shares that we had to issue for those stock options. So fully diluted earnings per share in this case would be $4.76. Okay, let's take a look at one more example. And again, this is the example of conversion of options. We're going to use the treasury stock method. And in this case, it's pretty much it's a duplicate of the slide we talked about previously. Just a couple little differences. Again, Tower 1 had $500,000 of net income, 100,000 shares outstanding, just like the last slide. Company's effective tax rate is 20%. Key employees had options to purchase 20,000 shares at an exercise price of $15 a share. So all that information is the same. But now we have a little bit different information here. The average market price during the accounting period was $10 a share, and the end of the accounting period price was $15 a share. So again, if we do our basic earnings per share calculation, it would be the $500,000 divided by 100,000 common shares equals $5 earnings per share. Now, we have no necessary adjustment to net income, assuming the conversion of these securities, because these are stock options, so no adjustments are necessary. But we are going to have to adjust our common shares outstanding because we're assuming that all of those options, in effect, were converted into common shares. Okay, so we go through the treasury stock method again. Cash receipts from options $15 option price times 20,000 shares equals $300,000 worth of cash proceeds. Now we go through the same calculation we did on the previous slide. $300,000 worth of cash receipts, but in this case we're able to repurchase the stock or purchase the stock on the open market on the average at $10 per share over the year. So we take the $300,000 divided by the $10 per share, and it shows that we can repurchase 30,000 shares on the open market. So now in this case, the additional shares that needed to be issued above our repurchase shares, in this case, we take the 20,000 shares that we need, but we're purchasing 30,000 shares with our proceeds. That means basically we would not have to, there would be 10,000 shares that we would not have to purchase over and above the initial repurchase. So in effect, we have $500,000 of net income divided by 100,000 shares minus the 10,000 additional shares that we purchased off of the open market. In this case, it would be $5.56 a share. So in this case, these options we would not include, if this option was one of the option calculations, we would not include this in our diluted earnings per share because the denominator, in effect, is this calculation is actually making earnings per share go from $5 to $5.56. So this is anti-dilutive in this case. So this is an example of a calculation where we would not include this calculation in there because it increases earnings per share as opposed to diluting earnings per share. Okay, ABC Corporation had 100,000 shares of common stock. And 10,000 shares of 5% $100 par value cumulative preferred stock. Yes, I made a little change in there to make up for a typo error. No dividends were declared on either the common or preferred stock. Net income for the year was $1 million. What would be the basic earnings per share for the year? Again, when you're ready, go ahead and stop the slide. Do your calculation, or stop the video rather. Do your calculation. When you're ready, restart the video. Okay, number two, basically, net income for the year was $1 million. What would be the basic earnings per share for the year? And the calculation is $1 million minus our preferred dividends. And the reason we subtract that out, even though no dividends were declared, the liability to pay the cumulative preferred stockholders still continues. Therefore, that amount must be deducted from the income attributable to the common shareholders. And so it would be, and again, I'd show you the calculation on the preferred dividends. It's the 10,000 shares times the $100 par value times the 5%. That's going to result in the $50,000 worth of preferred dividends. We divide that amount then by 100,000 common shares, and we come up to B, $9.50 a share. Okay, let's take a look at number 3. ABC Corporation had 100,000 shares of common stock. And again, I have an error here where I say 10 shares. That should be 10,000 shares of 5% $100 par value preferred stock. No dividends were declared on either the common or preferred stock. Net income for the year was $1 million. What would be the basic earnings per share for the year? So again, go ahead and stop your video, and when you're ready again, restart the video and look at the slide answers. Okay, number 3, net income for the year was $1 million. What would be the basic EPS for the year? The answer is A, $10. And in this case, it would be $1 million divided by 100,000 shares of common stock. No dividends were declared for either the common or the preferred stock. Now, unless the preferred stock was cumulative, the preferred shareholders are going to miss their dividend for the year, so there's no additional liability to the company. which is the case in this case. We don't, since the board of directors did not declare a dividend and the stock was not cumulative, we don't have to subtract anything from the net income available to the shareholders. Let's try number 4. Nexol had the following capital structure. Now this is a complex capital structure. We have more than one type, more than just a common stock. And the question here is, you're given a number of pieces of information. The question here is, what should Nexol report as basic earnings per share earned in the current year? So again, take a look at all this information, stop your video, and when you come up with the answer and you're ready to start your video again. Okay, one of the things we need to consider is the preferred stock in terms of, is this convertible into some type of common stock. And here it says preferred stock, it's cumulative, 25,000 shares issued and outstanding. Nowhere does it say it's convertible, so we don't have to do anything in terms of conversion with the denominator. So now let's take a look at the income that would be available to common shareholders in this case. Now, first of all, the dividends and arrears were deducted from the previous, from the income available to common shareholders in the previous year's calculations. So there was, even though, it was cumulative preferred stock, but in the prior year that was already deducted, so we really don't have to worry about that first $10,000. Now, of the $16,000 of dividends paid in the current year, $10,000 of those dividends pertain to the dividends and arrears on the preferred stock from the previous year. And again, that was covered in our previous year's financial reporting. That would mean that $6,000 was available to pay the $10,000 cumulative preferred liability in the current year. And that also means that we paid $6,000, but we still have $4,000 of dividends and arrears. So, in effect, in the current year, $10,000 of dividends would be deducted from the income available to the common shareholders, and this would consist of the $6,000 we did pay that pertain to the current year, plus the additional $4,000 of dividends in arrears for the current period. So that means we're going to deduct $10,000 of dividends due to the preferred shareholders that will not be available to the common shareholders. Now, I do have a typo here, which I'm going to magically change right now. Okay, now if we take a look at the calculation here, it would be our net income available to shareholders would be $490,000, which would be the $500,000 of net income we stated up here in the problem, minus the $10,000 of our current dividends, which is our $6,000 worth of our current dividends, plus the $4,000 of the current year unpaid preferred dividends, or the dividends now in arrears. That then would be divided by the 200,000 shares of common stock, and the price would be $2.50 a share. So the answer in this case would be D, $2.50 a share. Okay, let's go on to question number 5. And I know you had this in class. Most people didn't get it, so let's try it again. ABC had only common stock outstanding. During year 1, 100,000 shares were outstanding. In year 2, the following common stock transactions occurred. And then it asks you what basic EPS should the company report on its income statement for years 2 and years 1. So again, basic EPS. So go ahead, read the information when you're ready, or go ahead and stop the video and do your calculations. When you're ready for the answers, go ahead and restart the video. In this case, the answer is going to be what basic EPS should the company report on its income statement for years 2 and 1. And what we see here is the answer would be B, year 2 $1.78 and year 1 $1.75. If we take a look at the calculation for year number 2, we start out with our beginning balance of 100,000 shares outstanding. We have a 2-for-1 stock split, so we have to do a retroactive adjustment, and that's for January, February, and March. So that's for 3/12, and our weighted average comes out to $50,000. In April, we sold 20,000 shares. So there are 120,000 shares now that are outstanding because we sold those shares. And again, we have to retroactively adjust that for our 2-for-1 split for 3 months again, April, May, and June. So it'll be 120,000 times 2 times 3/12 equals 60,000 weighted average. And lastly, we account for in July the 2-for-1 stock split. We have 240,000 shares now outstanding, and that's for 6 months. So we have a weighted average of 120,000 shares. So that's going to equal 230,000 shares for year 2. So we take the $410,000 worth of net income, and we divide it by the 230,000 shares, and we come up to $1.78 a share. Now, we have to remember that we retroactively adjust that 2-for-1 split all the way back through year number 1. So in this case, we take our $350,000 worth of net income, and we divide it by the shares outstanding, which were 100, or by 100,000 times 2, or in effect 200,000 shares, and we have the restated. We have our earnings per share that are restated, based for the 2-for-1 split of $1.75 a share. Okay, let's now take a look at question number 6. Phillips Windsor Corp. had 300,000 shares of common stock issued and outstanding at the end of year 1. On July 1st of year number 2, an additional 50,000 shares of common stock were sold. On March 1st, key employees were granted stock options to purchase 40,000 shares of common stock at $15 per share. None of these options were exercised in year 2. The average market price for the company's common stock was $20 during the year. What is the number of shares that would be included in calculating diluted earnings for year number 2? So go ahead and attempt your calculations. Stop your video, and when you're ready for the answer, go ahead, restart the video and review the solution slide. Okay, number 6. What is the number of shares that would be included in calculating diluted earnings for year number 2? And the answer would be B, 335,000 shares. So when we're doing the calculations for diluted earnings per share, we have to take into account the stock options, because these are basically convertible securities. So these stock options were issued in March, but you need to remember that even though they're issued in March, we need to treat them as if the stock options were actually exercised as of at the beginning of the year. So in this case, what we're going to do is we're going to calculate the amount of diluted securities through the treasury stock method, because that's what we use for options and warrants. So the procedure is, first of all, the proceeds from the exercise of the options, if we assume that they were exercised, that would have been 40,000 options, or 40,000 shares, times the $15 per share average option price, or $15 per share option price. That's going to equal proceeds of $600,000. Now, what we're going to do is, using the treasury stock method, we assume, we don't necessarily do this, but we assume that we can go on the open market and buy those shares of stock, and then give them to the employees who had purchased the stock through the stock options. So in this case, we could purchase the stock from the open market, where we have $600,000 worth of cash proceeds. The average price during the year was $20 per share, so that means we could have purchased approximately, well, in this case, we could have purchased 30,000 shares during the year. Now, the only problem is that we could purchase 30,000 shares, but we need to have 40,000 shares in order to fulfill the requirement of being able to issue 40,000 shares to the people who purchase the stock options. So what we need to do is calculate the additional shares that would have to be issued to reach 40,000 shares. So that would be the 40,000 required option shares minus the 30,000 shares that we purchased on the open market. That means we're going to have to come up with 10,000 additional shares to be issued by the company. So what we need to do is we need to add these 10,000 shares as dilutive securities, and we do that as if they were exercised at the first of the year. So when we calculate a weighted average, it will be the 10,000 times 12 months out of 12 months, or the weighted average would be 10,000 shares. Now we also have to remember that we had a beginning balance in terms of shares outstanding of 300,000 shares, and those 300,000 shares were outstanding from January all the way through June, so that's 6 months out of our 12 months. So 300,000 times, in effect, 1/2 equals 150,000 is a weighted average. In July, we sold 50,000 shares, an additional 50,000 shares, so our shares outstanding go from 300,000 to 350,000. And July through December, again, is 6 months, so again, that's another half of a year. So we take 350,000 times 1/2, and it adds up to 175,000. We add up our dilutive securities of 10,000 plus our weighted averages of 150 and 175. That comes up to a total 335,000, which is the answer for B, 335,000. Let's take a look at question number 7. This company had the following capital structure. In year 1, common shares of 110,000 and convertible preferred of 10,000 also, and the same amount of shares in year number 2. During year number 2, the company paid dividends of $3 per share on its preferred stock. The preferred shares are convertible into 20,000 common shares. Okay, net income for year 2 was $850,000, and assuming an income tax rate of 30%, what is the diluted earnings per share for year number 2? So again, as you do your computations, go ahead and stop the video, and when you're ready, restart the video and take a look at the answer. Okay, number 7. Again, the question was, assuming an income tax rate of 30%, what is the diluted EPS for year number 2? Now, right away, we can, assuming an income tax rate of 30%, that is nothing more than a distractor because it really doesn't enter into the question, the solution to the question at all. What we need to do, though, is calculate what are the dilutive shares. And in this case, we know that there are 20,000 shares that are basically going to be from the conversion of our 10,000 convertible preferred shares. Here you see the preferred shares are convertible into 20,000 common shares. So if we do that, it's the 20,000 common shares from the conversion plus 110,000 shares of common stock. That means we're going to have 130,000 shares of common stock. So our diluted earnings per share will be the $850,000 in our net income divided by the 130,000 adjusted shares of common stock, and that equals $6.54, and that is our answer. That's answer B, $6.54. Okay, let's try number 8. In determining diluted earnings per share, dividends on non-convertible cumulative preferred stock should be, and we're given 4 choices. Go ahead and make your choice and stop the video. Go ahead and make the choice, and when you're ready, restart the video for the solution. Okay, number 8, in determining diluted earnings per share, dividends on, and here's the key, non-convertible cumulative preferred stock should be, in this case, A, disregarded. Remember, only common stock equivalents are considered in dilution, meaning that only if only if that preferred stock was convertible would it be considered for dilution. In this case, non-convertible stock cannot be converted into common stock. Let's take a look at number 9. BAB Corp had basic earnings per share of $15. The company had convertible securities that would reduce basic EPS by 75 cents a share. The company had a series of stock options that would have increased EPS by 10 cents a share. So what is the diluted EPS? Again, go ahead and stop the video. When you've arrived at an answer, restart the video and view the answer slide. Okay, let's take a look again. What is the diluted earnings per share? In this case, the answer is A, $14.25. Again, for diluted earnings per share, all potentially dilutive securities are included. In this case, these convertible securities would reduce EPS by 75 cents a share. Any items that are anti-dilutive are not considered as in the calculation. And in this case, the company had a series of stock options that would have actually increased EPS by 10 cents a share. So in this case, we would not include that part of the calculation in our diluted earnings per share. So it would be the $15 per share minus the 75 cents per share, which would give us $14.25. Now let's take a look at number 10. And on July 1st of year 1, Goliath National Bank issued 20 $10,000 7% bonds at their par. Each bond was convertible into 200 shares of common stock. There were 10,000 shares of common stock outstanding at the beginning of year 2. The bondholders converted all their bonds into common stock on July 1st of year 2. GNB's income statement for year 2 was, and we see the revenue, the operating expenses, the interest that the Goliath paid on their bonds, their income before taxes, tax rates, and so forth. And the question is, what are GNB's diluted earnings at the end of year number 2? So again, go ahead and stop your video, make your calculations, and when you're ready, restart the video and review the solution. Okay, we're asked in this case for number 10, what are GNB's diluted earnings at the end of year 2? And the answer is B, $2.85. And here's how we come up with that calculation. First of all, if we wanted to come up with the basic earnings per share, it's a matter of the net income divided by 10,000 shares, and that would be $3.50 per share. But in the case of our diluted earnings per share, it's going to be our $35,000 worth of net income. Now we're assuming that the bondholders basically did convert all their bonds into common stock as of July 1st for year number 2. So in this case, basically it's going to be the $35,000 net income plus the $7,000 worth of interest on bonds times the effective tax rate, and that comes up to $39,900. So to calculate the diluted earnings per share, it's $39,900 divided by our 10,000 shares plus the additional 4,000 shares of common stock, and that equals $2.85 a share. Okay, and with that, that is the end of our earnings per share video. Thank you for your time.